The rise of carry, the dangerous consequences of volatility suppression, and the new financial order of decaying growth and recurring crisis. By Tim Lee, Jamie Lee, and Kevin Coldiron. This is a book summary. Imagine a world where making money is as simple as betting that nothing bad will ever happen. A world where profits flow effortlessly, where markets seem to defy gravity, and where every downturn is met with an even bigger surge. But beneath this illusion of endless prosperity lies a darker truth, a system that's not just prone to collapse, but practically designed for it. This might sound like the plot of a dystopian thriller, where powerful elites pull the strings, central banks act as the hidden puppeteers, and regular people are left holding the bag. But it's not fiction. It's the unsettling reality of modern finance, and it's all thanks to something called carry. In their groundbreaking book, The Rise of Carry, Tim Lee, Jamie Lee, and Kevin Coldiron pull back the curtain on how the dangerous game of suppressing volatility has not only reshaped the global economy, but has also paved the way for a new financial order, one of decaying growth, recurring crises, and skyrocketing inequality. They argue that carry is more than just a financial strategy. It's the hidden engine driving market bubbles, wealth concentration, and even the actions of central banks themselves. So, why does the stock market keep soaring, even when the economy is barely crawling forward? Why do central banks seem to bail out the rich time and time again, while the rest of us are left to deal with the fallout? Is there a way out of this cycle, or are we doomed to keep repeating it until the next crash makes 2008 look like a dress rehearsal? Stick around, because by the end of this video, you'll understand why markets behave the way they do, how the rich are getting richer without lifting a finger, and what this all means for your money and your future. Chapter 1. The Secret Game of Carry Trades. So, what exactly is carry? To the untrained eye, it might look like just another finance buzzword. But don't be fooled. At its core, a carry trade is a financial bet that makes money as long as nothing bad happens. It's a way of cashing in on stability, or rather, the illusion of stability. Picture this. You borrow money at a rock-bottom interest rate in one currency. Let's say the Japanese yen, where rates have been near zero for decades. You take that money and invest it in something offering a higher return, like Brazilian bonds or real estate in Turkey. As long as exchange rates stay calm and no unexpected shocks hit the market, you rake in the difference, the carry. It's like getting paid to believe that the status quo will never change. But here's the catch. Carry trades are like picking up nickels in front of a steamroller. The gains are small and steady, until they're not. Because when things go wrong, they go very wrong. When exchange rates shift or markets crash, the losses can be catastrophic. It's a high-stakes game of chicken with the financial system itself. And here's the twist. This strategy isn't just limited to currencies. It's infected every corner of the financial world, from stocks and corporate debt to real estate and even central bank policy. According to The Rise of Carry, the entire financial system is now hooked on carry. Financial institutions, hedge funds, and even corporations have become addicted to this steady drip of profits. And like any addiction, the longer it goes on, the worse the consequences become. Take the US stock market, for example. It's no coincidence that the S&P 500 has turned into a kind of carry trade itself, with investors borrowing cheap dollars to buy American assets. This endless cycle of borrowing and buying keeps pushing asset prices higher, even as the real economy struggles to keep up. And each time the system wobbles, central banks step in, not just to rescue the markets, but to keep the carry trade alive. It's a financial house of cards, built on the assumption that volatility, the natural ups and downs of markets, can be tamed forever. But as the authors warn, the more you suppress volatility, the bigger the explosion when it finally breaks through. And make no mistake, it will break through. The only question is when and how devastating the fallout will be. So if you think that the last financial crisis was bad, you might want to buckle up. Because according to The Rise of Carry, what's coming next could make 2008 look like a warm-up act. Chapter 2. The Power Players, Central Banks and the Carry Regime. You might wonder, why don't these crashes destroy everything? How is it that, time and time again, financial markets are saved from the brink, while the rest of us watch in stunned silence? Enter the heroes of this twisted story, the central banks. In theory, they're supposed to stabilize the economy, acting as the guardians of financial order. But according to the rise of carry, they've transformed into something far more sinister. Enablers of the very system they're supposed to keep in check. Imagine a firefighter who secretly starts fires just to justify their own existence. That's the paradox of central banks today. They claim to be extinguishing financial blazes, but they're also handing out matches and gasoline. Every time a carry crash looms, central banks swoop in with emergency rate cuts and tidal waves of liquidity, bailing out traders and ensuring that the true scale of losses is never felt. It's like a parent who never lets their child face the consequences of their actions, and the child, in this case Wall Street, learns only one lesson: keep pushing the limits. The authors of The Rise of Carry argued that this isn't just misguided policy, it's a fundamental flaw in the system itself. By suppressing volatility at any cost, central banks have made carry trades look safe, even when they're anything but. The result? An endless cycle of risk-taking, crashes, and bailouts. It's financial Groundhog Day, with each crisis setting the stage for the next, bigger one. And every time the dust settles, it's the rich who come out even richer, while ordinary people are left to pick up the pieces. But it gets worse. Because the real twist is that central banks aren't really in control at all. They're trapped, caught in a cycle of their own making. Here's how it works. Suppressing volatility is like keeping a lid on a pressure cooker. The more you tighten it, the bigger the explosion when it finally blows. Every time central banks step in to calm markets, they make the next crisis even more inevitable and more catastrophic. In The Rise of Carry, the authors reveal that this isn't some unintended consequence. It's baked into the system. Central banks have become the ultimate agents of the carry regime, a world where financial markets can't survive without an endless stream of cheap money, and where volatility isn't just a risk to manage, but an enemy to be eradicated at all costs. It's why the S&P 500 has become a kind of proxy for the global carry trade itself, rising steadily as long as the volatility stays low and central banks keep the liquidity flowing. Think back to 2008, a crisis triggered by too much risk, too much debt, and too much faith that housing prices could only go up. The solution, we were told, was an unprecedented wave of liquidity and near-zero interest rates. But instead of fixing the problem, it supercharged the carry regime. Banks and hedge funds doubled down on leverage and risky bets, knowing that if things went south, central banks would have their backs. And it's not just a US phenomenon. From the European Central Bank to the Bank of Japan, every major central bank has been dragged into the carry regime. With interest rates pinned to the floor and trillions in quantitative easing, they've all become complicit in this dangerous game. A game that's inflating bubbles in everything from real estate to tech stocks to government bonds. The authors warn that as this game goes on, the stakes keep getting higher. Because here's the terrifying part: central banks can't stop. If they try to raise rates or pull back liquidity, the whole system wobbles. Asset prices start to deflate, carry trades unwind, and the very thing they're trying to avoid, a catastrophic crash, becomes a self-fulfilling prophecy. It's like being on a speeding train with no brakes, where slowing down even a little might cause the whole thing to derail. So, the next time you hear about a central bank stepping in to calm the markets, remember, they're not just fighting the fire, they're the ones who helped start it. And if this cycle doesn't change, we're all going to get burned. Chapter 3. How carry is reshaping society. But it gets even darker. Carry isn't just reshaping markets, it's reshaping society. The rise of carry has quietly rewritten the rules of wealth and power, creating a world where privileged few thrive while the rest struggle just to keep up. As carry trades push asset prices higher and higher, the rich, who own most of these assets, see their wealth soar at a dizzying pace. Meanwhile, wages for the average worker barely move, small businesses grapple with rising costs and limited credit, and entire communities are left behind in the dust. In this new financial order, access to cheap credit and assets isn't just a privilege. It's the dividing line between winners and losers. It's a kind of modern-day feudalism, where your ability to borrow cheaply determines whether you own the castle or toil in the fields. Think about it. When central banks flood the system with liquidity and push interest rates to the floor, they aren't just saving markets. They're creating a world where debt is the ultimate weapon of wealth. For the wealthy, who can borrow against their assets at almost no cost, it's an invitation to buy more real estate, more stocks, more everything. But for ordinary people who rely on wages instead of assets, this cheap money does almost nothing. Their savings earn next to nothing, their paychecks barely stretch to cover the rising cost of living, and their dream of owning a home drifts further out of reach. It's a financial Hunger Games where the odds are stacked in favor of those who already have the most. And nowhere is this more obvious than in the way corporations are using cheap money. If you've ever wondered why companies seem obsessed with buying back their own shares instead of investing in new products, better wages, or groundbreaking technologies, you can thank the carry regime. Here's how it works. With interest rates at rock bottom, it's cheaper than ever for companies to borrow money. But instead of using that cash to build new factories or hire more workers, they're using it to buy back their own stock, pushing share prices higher and making executives, who are often paid in stock options, even richer. It's a win-win for the wealthy and a dead end for everyone else. And this obsession with stock buybacks isn't just a minor quirk of modern finance. According to the Rise of Carry, it's a cornerstone of the carry regime, a new financial order built on low volatility, high leverage, and massive inequality. The idea is simple. As long as markets are calm and interest rates stay low, borrowing money to buy assets is a no-brainer. And the longer this game goes on, the bigger the gap grows between those who can play and those who can't. This is why, despite record low unemployment and a decade-long bull market, most people feel like they're falling behind. The rising tide isn't lifting all boats, it's lifting yachts while the rest are left treading water. According to the authors, this isn't just an economic issue, it's a social and political time bomb. Because when a tiny elite controls most of the wealth, the system starts to unravel. Social unrest becomes inevitable. Populist movements gain momentum, and faith in the very idea of capitalism begins to crack. As long as central banks remain committed to suppressing volatility and keeping interest rates low, the carry regime will keep feeding on itself, making the rich richer, the poor poorer, and the middle class an endangered species. The authors warn that this growing divide isn't just a financial problem, it's a threat to democracy itself. Because when wealth becomes this concentrated, so does power. And when billionaires can buy elections and influence policy at will, the average citizen's voice starts to fade into the background. It's a world where the rules aren't just unfair, they're rigged. So, what's the solution? According to the Rise of Carry, breaking the carry regime would require a complete overhaul of how we manage the economy, higher interest rates, tougher regulations on corporate borrowing, and policies that prioritize wage growth over asset inflation. But getting there won't be easy. Because in a world where financial markets have become the economy, even the smallest move to rein in the carry regime risks triggering the very crash everyone fears. Chapter 4. The next crisis is inevitable. If this all sounds unsustainable, that's because it is. In the Rise of Carry, the authors warn that the financial system we've built is not just fragile, it's a ticking time bomb. A bomb that's been rigged to explode with every new layer of debt, every emergency interest rate cut, and every central bank intervention that papers over the cracks instead of fixing the foundation. In their book, the authors describe how the carry regime works like a drug. Low volatility keeps investors hooked, encouraging them to take on more leverage, to borrow more, risk more, and push asset prices even higher. It's a self-reinforcing cycle, with every new bet making the system more unstable, not less. And like any addiction, the longer it goes on, the harder the crash will be. Just look at what's happened since 2008. To keep the carry regime alive, central banks have slashed interest rates to zero, or even below zero, and unleashed wave after wave of quantitative easing, buying up government bonds, corporate debt, and even stocks in some cases. It's kept the party going, but it's also left central banks with almost no ammunition for the next crisis. And the risks aren't just in the stock market. The Kerry regime has transformed everything from corporate debt to real estate to emerging markets into powder kegs of leverage. In the US, corporate debt has exploded to over $10 trillion, much of it in risky, high-yield bonds that rely on low rates to stay afloat. Companies have borrowed trillions not to invest in growth, but to buy back their own shares, inflating stock prices and making executives even richer. In the words of the authors, the Kerry regime has turned the market into a hall of mirrors, where asset prices no longer reflect reality, but the distorted image of endless cheap credit. And it's not just the US. In emerging markets, companies have binged on dollar-denominated debt, borrowing cheap dollars to finance projects that generate income in their local currencies. As long as the dollar stays weak and interest rates stay low, it works. But if the dollar surges, or if interest rates rise, those debts become unpayable overnight, triggering a wave of defaults that could ripple through the global financial system. Chapter 5. Is there a way out? After all the doom and gloom, it's a question worth asking. The authors of The Rise of Kerry don't sugarcoat it. Breaking free from the Kerry regime would require nothing short of a revolution in how we manage our economy. It would mean dismantling a financial order that has been decades in the making, one that thrives on low interest rates, cheap debt, and endless bailouts for insiders. To pull it off, we'd need to embrace some bitter medicine: higher interest rates, limits on leverage, stricter regulations on financial institutions, and a return to fundamentals where risk actually carries consequences. Imagine a world where banks couldn't borrow at near-zero rates to fund risky bets, where corporations couldn't use cheap debt to buy back their own shares, and where central banks weren't playing the role of firefighter, arsonist, and architect all at once. And that raises the real question: do we have the political will to endure that pain before the next crisis forces our hand? Because as the authors make clear, if we wait too long, the decision might be made for us, not in a boardroom or on Capitol Hill, but in the chaos of a market collapse that no amount of liquidity can contain. One possible path forward, they suggest, is a new Bretton Woods, a global financial reset where the major economies come together to rewrite the rules of the game. It would mean reining in the power of central banks, putting guardrails around leverage, and finding a way to restore some balance between financial markets and the real economy. But that kind of coordination would require unprecedented levels of trust and cooperation between countries. Another option would be to embrace what the authors call an anti-carry regime, a system designed to penalize leverage and speculation instead of rewarding it. Imagine a tax on short-term capital flows, a cap on corporate buybacks, or a financial transaction tax aimed at high-frequency trading. The goal would be to shift the balance of power away from speculators and back toward productive investment, the kind that creates jobs, builds infrastructure, and raises wages instead of just inflating asset prices. But even if these reforms were politically possible, and that's a big if, there's no guarantee they would work. The Kerry regime has been decades in the making, a web of incentives and policies so complex that unraveling it might just trigger the very crisis we're trying to avoid. So, is there a way out? Maybe. But it won't be easy, it won't be quick, and it won't be painless. The real question isn't whether we can break the Kerry regime, it's whether we're willing to pay the price to do it. Because if we're not, then we might as well admit that we've made our choice. A world where financial crises aren't an anomaly but a feature of the system, where the rich get richer, the poor get poorer, and the next crash is always just one margin call away. We're living in a world where financial markets aren't just a reflection of the economy, they are the economy. A world where central banks have become the dealers for an addiction to cheap credit, where stock buybacks replace real investment, and where crises aren't the exception but the rule. So, what do you think? Are we doomed to repeat this cycle of bubbles and crashes, or is there a way out? Can we muster the political will to rewrite the rules before it's too late? Or is the carry regime too entrenched, too powerful, and too profitable to fail? Let us know in the comments below, and don't forget to like, subscribe, and hit the bell icon for more deep dives into the dark side of finance. Thanks for watching, and see you in the next one.